right. Hello, everyone. Welcome back to another episode of Investor Inquiries. We have Mr. Edwin D. Epperson III here with us again today. And how's it going today?
I'm doing well, man. How are you? Happy day after Thanksgiving or happy week
Yeah.
after Thanksgiving?
Yeah, this is it was a great Thanksgiving. Got to spend it with some friends. What about yourself?
Yeah. Actually, my wife and I went up to Kentucky, where I was born and raised, and
Nice.
spent some time up there in the frigid cold. It is not
Yeah.
Florida, and I am happy to be
No.
back home.
Yeah, I bet. Yeah. It was snowing up in Missouri where we were from, I think, on
Oof.
Thanksgiving. So yeah, I was glad I wasn't up there.
Yeah.
Well, glad and not, but yeah. So today we're going to talk about some low and no money down strategies. So how do we reduce that 20% that's typical for bringing to closings when we're going to purchase a rental property or flip or whatever? And how is that actually working in reality? So there's a lot of people out there preaching on the low and no money down strategies, and a lot of them are, well, we're going to take funds from like some other place where you have money or funds, and we're going to use that to cover the closing costs. So it's not cash out of your bank account, but it is going to be cash out of your IRA or your 401k. So I don't want to talk about those strategies. I want to talk about like the real, like how do we reduce that? And then how do we work with our lenders to make certain that that's all kosher, that we're going to be okay with that. The lender's going to feel comfortable with that. So that's what we're talking about today. To get us started, let's go in and talk about subject to financing. I'm hearing a lot
Okay.
of subject to financing, a lot of talk around that. Can you give us a brief overview of what subject to is?
So, in the subject to financing, you are, or the real estate investor is really taking ownership to a property. They're taking title or deed, excuse me, to the
Mhm.
property, subject to the existing financing staying in place. So you subject to financing is actually not getting new financing. You're not getting a new lender. You're literally playing off the existing mortgage on the property. What are some pros and cons to that? Well, the biggest pro is that you don't have to personally qualify for the loan. You are simply taking deed to the property, and you have control of the property, right? So the disadvantage is, if there's work that needs to be done to the property, you're not getting the funding for that work to be done to the property because it's subject to the existing lien in place, or the existing mortgage or mortgages, if you will.
Mhm.
So that raises the concern for subject to that are wanting to do fix and flip. You have to have access to capital. So, and here's the thing: if the existing mortgage or the existing lien against the property is from a large bank or a financial institution, and let's say an investor were to come to me like, Mr. Epperson, I've got an existing loan in place. It's, the property's worth today 200,000. The existing loan is 100,000. It needs about $50,000 in work, but after it's complete, it'll be worth around. They're really solid numbers, good numbers. And if I were to go in and say, okay, well, I'll provide you the $50,000 for the renovation. Number one, I would be in second position behind a bank first position. Number two, there is a intercreditor agreement, which is a document that typically all junior lien position holders should get with all senior lien position holders. So if I'm in second, then I want an intercreditor agreement with the first. If I'm in third or fourth, then I want an intercreditor agreement with every single lien position ahead of me. The disadvantage to that is most banks or financial institutions who somebody is, and again, this is assuming the property has institutional financing in place in first position. In that case, most of those institutional lenders are not going to be okay. They may not. I won't say they will not. They may not be okay with the second position loan being placed on, because again, then they're going to say, well, who is this that's taking the loan out? So it's a different person than the person they loaned their first position money to, and that could trigger
Yeah.
the due on sell clause. So you the likelihood that you will get another lender to fund and have a recorded lien against the property in second position or a more junior position to finance the renovation on a subject to acquisition, the likelihood of that happening is very slim. The way around that is if you have a personal relationship with an individual that is not in the business of making loans. So I'm in the business of making loans. I know how the industry works. And my entire approach to lending is mitigate, control my risk, and then
Yeah.
shift that risk to the borrower. Right. So that is the name of the lending game. So if somebody wants to do subject to and do like a fix and flip and then sell it, That's perfectly fine. What you're going to want to focus on is, number one, individuals that will loan you the money based on trust. It is a trust factor. They're going to loan you the money, and it's not going to be secured. So the lender, will have to be okay the loan being an unsecured loan. Now, you could do a mezzanine financing. You could do some financing to where the loan is attached to the entity itself, but then it's a strictly business to business, and you potentially could collateralize all other assets on that business that business has, which is a way around actually loaning directly or attaching your loan directly to the mortgage. But the problem with that is, if somebody declares bankruptcy or they move the entity or the property out of their entity, then whoever did the loan to the entity to fund this renovation on a subject to is left to the wind. And it's very easy to move assets out of an entity. So that's just a concern for the subject to. Now, if the investor is going to do a subject to for rental, and this is probably the best strategy, whether a long-term rental or short-term rental, they're going to, somebody's in a dire straits. They want to get out of the property. And then here's another option. So let's say they want to do an Airbnb or short-term rental. They have the opportunity to get this property subject to the existing financing in place. The existing financing makes sense. And matter of fact, I have to say, Chris, in the coming quarters, this is going to be a huge strategy, especially for those that don't have capital, because what you have is a bunch of loans that were taken out in the past couple of years where interest rates were ridiculously low. And life happens. We understand that. And maybe the house needs some repair, so they can't sell it on the open market, but they're in a position they need to get rid of the property. That's where these subject twos are really going to come in and shine. So what somebody can do is set up an entity specific for that property to do the subject to. They can bring in a capital investor that wants to be part, and that capital investor is in that entity specific to that property. That's a workaround. That way, that capital investor is not collateralizing all assets underneath their other holdings, right?
Yeah.
And then that investor is basically funding the renovation, but they now have equity in the property. So that's an easy way to bring on or raise capital is, hey, you're going to have equity. Now, I will caveat this. I am not an attorney. You will need to talk to an attorney about raising capital this way, because what you are selling is a security. You are selling interest in your company for the benefit of raising this equity in this property. You are selling a security. So you have to abide now by the SEC regulation to raise capital. That being said, the SEC is not out there looking through their website, and looking through every single entity that could possibly be raising money. And then, is this entity registered with the SEC? They don't do that. So I'm not encouraging people to go out and do this. But just know the SEC does not have the manpower to look through every single post on every single social media platform and monitor every email for a company that's raising capital that's not registered. What's going to happen is, if your real estate investor raises capital, the deal doesn't work out as planned, and then that capital investor loses money, that capital investor could go to the SEC and say, hey, listen, is this person legally able to raise capital? And the SEC will then do the research, like, nope. And then there's the hammer that comes down. So that's sort of the way forward to go through with subject twos, because they will become very popular in the next couple of quarters.
Yeah. I mean, like there's the whole, I've seen a lot of people out there talking about how the math behind where property value should drop by. If we have a bunch of property values that were, financed out at like a 3.5% interest rate or whatever, your mortgage payments are here. Well, people buy homes based off mortgage payments. So if we want to keep the same mortgage payment, but our interest rate is way over here now, the property values need to drop so that value can stay the same. So what we're going to be able to do is purchase properties with that old financing, and we can still pay people, those premium.
And technically, you're not purchasing the property. So again, you're transferring deed to the person that is assuming the that financing, subject to that financing.
So it's been a pretty powerful strategy. I've gotten to advise a couple people on pursuing that. Actually, my parents are doing that with a VA loan right now. They have a VA loan on their home that they're trying to sell, and they're trying to get that established as a subject to, which it is possible for some VA loans to be done like that. It really depends on the actual bank who is doing that loan, servicing it. But you had said something in there earlier, intercredit agreement.
Intercreditor agreement. Now, this is specific. This is something that I'm talking specific to the lien holder or the lender. Your borrower, the real estate investor, I mean, honestly, they don't care. What I'm really, again, because my focus is lending, from a lender's perspective, that's something that I would require. And you're not going to be able to get that creditor's agreement with a financial institution with an existing lien already in place. That's why I'm saying for real estate investors that are looking for financing for the fix and flip, going to somebody who is advertising or marketing on Facebook or social media or doing any type of they're running a business. None of those businesses will give you a second position lien on a subject to property. It's just not going to happen. So what's going to happen, what they're going to need to do is find just an individual that is not in the business of making loans, that is interested in loaning money, and they are interested or okay being in an unsecured position. And with that risk, there's a reward, right? And as long as the real estate investor is willing to reward them based on that risk and it makes sense, then that's something that they can line up.
Yeah. Going back to episode 1, that's that private money individual, not the private lender, not your hard money lender. That's
exactly.
Yeah. So something that's sort of like subject to, let's talk about seller financing. What is seller financing? Let's start there.
So seller financing is when somebody owns the property, and we'll go with the simplest, cleanest way that this is done. They own the property free and clear, right? And they're willing to sell you, the real estate investor, their property for a price. And then they're going to determine, basically the seller or the owner of the existing property becomes the bank. They extend to you the ability to loan, and then they record that lien, and they are now in first position. So that's the cleanest method of seller financing. However, most homeowners they don't have that mindset. So it really is, okay, how does the real estate investor educate a homeowner to become a seller financer or seller financing and become the bank? Also, the complication comes in is how many people that need to sell their home and they're willing to take a discount do so with it free and clear. Most people have free and clear property and they need to sell the property. Well, they'll just put it on the open market because they can, it's free and clear. There's not existing lien, even if the property's in disrepair.
Yeah.
So the problem or the situation comes in was there is existing financing, and really seller financing would be the seller being educated or aware of themselves that they could do this, is seller financing with the subject to on the existing lien. So the way that this would work is the owner, who's technically the seller, would be selling the property to the real estate investor. The real estate investor would be buying that property subject to, so it's a combination of subject to, right?
Yeah.
The real estate owner would be buying the property subject to the existing financing, and then the agreement of buying the property from the owner would now be a different agreement. So for instance, let's say that the homeowner had an existing lien in place. The property's worth $200,000. They owe $150,000 left on the property. It's in decent repair. Maybe this is in a great location to do short-term rentals. So your real estate investor identifies this person, like, okay, their $150,000 remaining balance on this loan is at 4.25%. So great. It's, they've still got, it's a 30-year fixed rate loan. They still got like maybe, let's say, 27 more years. So great loan, great project. In the area, the short-term rental demands, like, let's say the monthly with principal, interest, and taxes, PITI, all of that for this project, let's say it's $1,000 just for round number's sake. Okay. Yeah. So $1,000, but in that area, the short-term rental, you could generate $2,000 in income on average, maybe a little bit more, maybe a little bit less. So this, for the real estate investor, is a great project. Now, if the borrower, or excuse me, if the seller is aware that they can do this, then what the seller would do is go back and say, okay, I'm going to sell you this. I know that the property is worth $200,000. I owe $150,000. I'm willing to not take any money right now, but I don't want to take a haircut. Like, I do want to make some money. So I'll sell you the property for $175,000. And then I'm going to charge you 6% interest. So I'm going to make 1.75% spread on my existing mortgage. For a owner, that's a great way to approach seller financing for the real estate investor. For the real estate investor, they don't want that, because clearly now they're having to pay more than what is owed. So for a real estate investor, your end goal is to get subject to financing, if the financing makes sense, right? If the
Yeah.
financing is good, that's your end goal. And your goal should be talking to that homeowner and sort of leading them down this path of subject to is a great way for me to buy the property from you without, you having to, and they can approach it as, this is a great way for you because I'm going to be making your payments. This loan is underneath your name and your credit. So your credit will continue to be really well established. And, this is a great way to rebound. Maybe the person is a couple of months late and, maybe they're about to lose their property. This is a way for your real estate investor to come in and say, hey, I will make whole. And this is a whole different, now we're getting off topic. Yeah. So, all right, let's just stick there. So subject to is how you get the existing financing in place. Seller financing is the same thing. If there's an existing lien on the property, if there's not an existing lien on the property, then it's really the real estate investor conveying to the seller, you can become the bank, you can collect monthly interest payments, you still have control of the property through a recorded mortgage or a deed of trust. I have deed to the property so that I can go and do with it whatever I need to legally. And it's a great way for you to talk. I don't want to use the word convince because it maybe sounds nefarious, but it's a great way for you to explain to a property owner how they can actually become the bank, how they can make money by becoming the bank, as well as still control the asset without getting rid of the asset. So
Yeah. I think talking about like how to sell seller financing to that homeowner could be an entire episode on itself.
Absolutely.
Like that, there's a ton of benefits for both parties. This is not something that like benefits just wholesalers. So I've done some of the seller financing before. It's actually really quality strategy, especially if you're getting started and you can find the correct property owner who's willing to listen to that and kind of do that thing. That is a very powerful strategy. But kind of what you went into, these strategies stacking, where we're taking little bits of each of these. This is really how you do like creative financing, as some people call it. Just trying to get the deal done however you can, which brings me into the next one that I want to get into, which is closing credits. And this is actually one of my favorite strategies to use. Is to talk to the person that's selling when you're negotiating a property, is to see if you can utilize any closing credits as a way to bring less money to closing, or any of the money that typically that's your down payment, along with a bunch of other stuff, is typically what you got to bring to closing. Closing credits go against that. So there's a couple things that you got to kind of watch out for. And talk to through your lender. Have you as a lender seen any problems with people utilizing closing credits, or what are some of the things that you might have seen around closing credits that you want to point out?
So to be upfront, I've never seen, I've been doing this since 2014. I've made over 100 loans, loaned out over 20 million in capital. I've never seen a seller bring closing credits to one of our deals. And I would say primarily this is because we're not talking about somebody who's selling the property on the open market, the MLS.
Yeah.
This is somebody who's in a position they need to get rid of the property, and either one of two things: the wholesaler has gotten the property under contract and the wholesaler is selling that contract to one of my buyers or one of my borrowers who will be the buyer, or my borrower has directly negotiated with the homeowner. I've never seen a closing credit, but my understanding of closing credits is this. So we've got the real estate investor who's going to be buying the property, and to get the property sold, the seller is willing to give money back at closing, which reduces the amount that they need to bring to closing. However, most of the deals that I'm lending on, there needs to be work that's completed. So you had mentioned earlier before we started this, if there's somebody that needs, a new roof, they're going to give you a credit for the new roof to be put on, but it doesn't really change the amount of money that needs to be brought to the deal because you still have to bring that money to the deal to get the roof fixed, right? So seller credits work in a retail market environment, but that's not the environment that I operate in at all. Like, so, if somebody came to me and they said, hey, I've got $10,000 worth of seller credit, I mean, that's great. I'm still going to look at, okay, what work needs to be done to the property, and then what is your plan for the property? And we can start going in, because I think one of the other questions is, how do you as a real estate investor can talk to your lender to say, hey, listen,
Yeah.
this is what I've got lined up. How can I get this deal done with less money out of my pocket? And we can dive into that. But at the
Yes.
end of the day, I'm still looking at the deal. What is the validity of this deal? Is it feasible? Is it capable? And is it reasonable to get this deal done? I'm really looking at the construction and repairs necessary for that deal, or the borrower's qualification to get a refinance loan into a 30-year fixed rate or something like that.
Yeah. So before we get into that next question, so like how I've utilized them in the past is
Mm-hmm.
I'll go in and look at a rental property that I'm looking at, and I'll say, well, the walls are pretty rough. You know that they're going to need to be repainted, or we're going to need to do new carpet or whatever. There's some small little repairs. If I can do those repairs, but negotiate a closing
Mm-hmm.
credit instead of a drop in the purchase price, negotiate a closing credit, that reduces what I have to bring to closing, my down payment, closing costs, whatever, to actually get that deal done. So I've actually negotiated to where, like, hey, I want, $5,000 in closing credits to repaint the walls, do some miscellaneous repairs, stuff like that. And then I go in and do the work myself as a general contractor. If you have that ability, you can go in and do that. It reduces where maybe, yeah, if I hired a painter, to come in and paint an entire house, maybe it would cost, a couple of grand. But if I go and do it myself, it costs me a Saturday, but I didn't have to bring that $5,000 to closing. Oftentimes we're talking about properties that are far more than a $5,000 closing credit, especially when you're talking about investor, closing or down payments, which are like 20%. So I mean,
And I would also say it depends on who your lender is. That would
yes,
possibly work with a bank or financial institution. But then a bank underwrites loans much different than I do, because I'm
yes,
looking at the asset. I don't care about your credit. I don't care about your proof of income. I'm not going to look at your tax returns. So all of that personal qualification, that
yeah,
financially, personally qualifying, I'm not going to look at anyway. So if somebody is looking to utilize credits at close because they're going through a bank, well, the bank's going to require you to bring money to the table. And I would venture to say a bank's not going to, I mean, for a real estate investment property, I don't know what a bank's down payment requirement is, but I that would have to be something that the real estate investor discusses with their banker of, hey, do these closing credits allow me to get into the project with less money down? For a financial institution, that might be the case. But again, most of the projects that we're looking at in the real estate investment world, they don't need $5,000 worth of work
yeah,
done, because they're getting them at a pretty good discount, or they should be anyway.
yeah. So that brings into the next thing. So all these different strategies are things that if you're going to try to use, I believe you need to have a solid conversation with whoever the lender is on your team.
Mm-hmm.
So how do we approach our lenders to make them feel comfortable with us trying to reduce our skin in the game? So like if we're in that situation where we don't have the 401k, we don't have an IRA account, we don't have, a big bank account, how can we talk to our lenders about, those struggles, but still trying to get our first deal done?
I would say this. I would ask this question, and then we
Yeah.
can gameplay this.
Yeah.
Does the investor have no money, or do they have money? They're just wanting to reduce how much they bring to the table, because that
Mm.
actually is two
Two.
very
Yes.
different borrowers, right? And
Yeah.
two different scenarios.
Yeah. Let's talk about the easier one first. So the borrower who has the money
Mm-hmm.
but doesn't wants to try to reduce what they need to increase that ROI, or the cash on cash return. So like
They
they're
want to
looking,
increase the cash on
they
cash
want
return by
to.
reducing the amount of cash they bring to the table.
Yes.
Yeah.
So let's talk about that one a little bit easier, because I know from a lender's perspective, that's going to be the person that they want to lend to over the person who has no money. So let's talk about that person first.
So I would say it, it sounds like maybe a broken record, but it really goes down to their experience.
Yeah.
I have seen somebody that's got 780 credit score. They came to me, they had hundreds of thousands in the bank, and the project that they were looking to do, I mean, they could very well have done themselves. Now, they reached out to me because they didn't want to utilize that capital. They wanted to keep that principal or that capital sitting in the account for whatever reasons, probably for financing in the future when they wanted to refinance. The problem was this was the very first deal that person ever did. And I will tell you, regardless of, it's the way the nature of the business is. Regardless of the team you have in place, the first 5 deals are going to be big lessons, meaning they are going to cost you and you're not going to make as much money as you think you are. And the repairs or whatever is happening is going to be different than what you went into the project with. That's just the nature of the business. And it's the nature of any real estate or any investing strategy, real estate, stocks, crypto. I mean, it doesn't matter. Your first venture into any type of new investing strategy, your lessons are learned by reduced profit and cost that you did not anticipate. So that's been a very true factor. I've never seen somebody that has never, and I'm talking about never done a deal or very, very new to this space, but they've got 1 or 2 deals under their belt. It's going to take them between 5 and 10 to get very comfortable and know that when they walk into the project, okay, this is what I need to do. And they're more accurate with their costs because they've actually seen what the cost to do these things are. So my first thing when I look at somebody, even when they have a lot of money, is what is your experience? If their experience is minimal or nothing, like they don't have any experience, I'm going to be I have to be honest, Chris, I don't think I've ever done a loan to somebody who has no experience without requiring 20% down. And this is the reason why. For me, it is a risk mitigation measure. When somebody, so there is a Bible verse that says where your heart is where your money is. That's where your heart's at. Where somebody believes in themselves, that's where they're going to put their money at. And if somebody is trying to do a deal, even if they have a lot of money, but they don't want to put any money in the deal, my first thing is, why not? Do you not believe in yourself? Are you not confident in your deal? Because the way I would rather work with somebody that was willing to risk it all.
Yeah.
Make me feel comfortable because I'm the lender and they're willing to make me feel as comfortable as possible. If I say, hey, I need 20, I need 25, I need 30%, they're like, you know what? I value the long-term relationship with you. I will work with you to get this done with the expectation that in the future, we can start working something out. And that's really what it boils down to. Real estate investors, they want the relationship with their lender that I would give somebody who I've done business with for years and have done 20 plus loans with. They want that benefits of that relationship with only doing 1 deal or no deals. Yeah. And it's like, hey, I've been to this seminar, I've got a network, I've got this and this. And that's fantastic. You need that to be successful, but that's not what's going to reduce, in my mind, the risk of that deal. It's your experience. It's huge.
Yeah. So what do you say to the investor who's come to you and maybe they do have that, 780 credit score. They got, $100,000 in the bank. They come to you and they're like, hey, I found this, property. Let me think of some easy numbers real fast. A $200,000 property. It's going to be a rental property. I'm going to Airbnb it out. Needs no work, very minor work. Maybe I'm going to spend, a Saturday or 2, painting, putting in some furniture. We got some stuff we're getting from garage sales or whatever. And the owner is willing to seller finance 40 grand, the 20% down payment. They have the ability to seller finance 40,000 of the 200,000. I need a loan for the rest of the 80,000. How do you have that conversation, or how would you handle that conversation if an investor was coming to you with that proposition?
So let's be very clear. We are now talking about a 30-year or a long-term loan. If your real estate investors are looking for short-term funding, meaning they need the fix and flip to then refinance in 30-year, that's where somebody like myself, which is a direct lender, I'm loaning my investors' capital, my capital out for a short-term period, 12 months or less, right?
Okay.
If somebody is looking for a 30-year, I can't honestly speak to what the exact underwriting requirements are because it's not my money. I'm not the one making the decision to loan that money. I have seen where that money comes from is Wall Street, comes from the secondary market. And I will tell you right now, the entire secondary market is in turmoil right now. I don't know if you were tracking, but Athos Capital, which was a huge originator of loans, and all of their loans, they were selling on Wall Street. Every single one. They were just selling the loans on Wall Street, which is very common. And most real estate investors don't realize that's the process of the hard money space today, or the private lending space. They even call themselves private lenders. But at the end of the day, those lenders are not actually loaning out their money, and they're not portfolio lenders, which is a great question that any of your investors can ask somebody when they go to someone.
Yes.
Are you a direct? Are you a portfolio lender? Those are two qualifiers that your real estate investors can ask any lender. And if they say they're a direct or a portfolio lender, that means the loan documents and everything will be recorded in that lender or that lender's company's name. If not, then they're simply selling the loan. And even then, there's actually a way that I could, if let's say I didn't have any money, but I was going to broker, I could say, yes, I'm a direct portfolio lender. And when I do the loan documents, it'll be my company. But what the investor doesn't know is that within a day after we originate the note, I'm then assigning that note and that mortgage to an actual secondary market buyer, which would be Wall Street. So the 30-year, the rental, that is a completely different space. And I honestly have to say that's something that they have to have a discussion with their lender. I'm not in that space. I'm not loaning my money out for 30 years. So I couldn't speak to what that looks like. I will say that I have come across that in the past, and I've brokered out money from the secondary market for 30-year fixed rate. And a borrower did come to us and say, hey, listen, the seller is going to give me a seller carryback. What was important is the lender or the investor for that loan, they wanted to know what the as-is value was, what was the ARV, if there was any ARV, and they wanted to know that the borrower, their borrower who was using that seller carryback. So seller carryback is different than seller financing, though technically it is seller financing because it's a carryback, but they wanted to use that seller carryback to reduce. And what the lender did is say, okay, if let's say the property is 200,000, and with this seller carryback of 40,000, you're having to bring 160,000, and the as-is value is, let's say, 200,000. Well, that 40,000 is 20%, right? So technically, the investor is coming to the table with 80, or they're coming to the table with 20%, and the end investor is lending 80%. The problem is that end investor, that lender, is looking at the combined, we call it the CLTV. So they're looking at the combined loan to value, and they're like, okay, our loan is 160,000, but there's a second loan for 40,000 with seller carryback. So the total loan amount is 200,000. The property's worth 200,000. That's a 100% finance deal. Not going to work, at least as far as what I saw. Now, again, if the real estate investor can negotiate, a good price, and then on top of that get seller carryback, it's a different scenario. But again, that has to be something that they have a conversation with their lender about.
Yeah. So it would actually be looking at like, okay, if we said in that scenario, then if someone did want to try to do that, assuming they had a lender that they could work with in doing this, they would want to say, okay, the as-is value is 200K. We can have a combined loan total value, CLTV.
CLTV, combined loan to value.
Loan to value. So a CLTV of 160 then for the 80% loan to value, basically. And then a 20% off of that would be, what is that, 38,000?
Yeah.
So 38,
32,000.
32,000. Thank you.
Off 160.
So
but again, this is the part of real estate investing that most real estate investors are not comfortable with, and that's negotiating with the seller. You have to negotiate a good price. You cannot find negotiated prices on the MLS. Like, that's just not going to happen. Or you're going to get a good deal, but guess what? To the lender, you're still going to need to bring a lot of money to the table. So the real estate investors have to be good, number one, identifying where to find those deals. And then number two, negotiating with the sellers and creating a scenario that the seller can walk away from. And the seller feels like they've come out on top. The real estate investor has definitely come out on top. And hopefully the real estate investor has been able to negotiate it in such a way that they can reduce the amount of money brought to the table.
Yeah. So very interesting. So if I got my math all correct, so in that scenario, if they were to get that $200,000 property, get a purchase price negotiated down to the 160, they'd be looking to seller finance 32K and then have the bank finance the other 128,000.
Yeah. And again, a bank's going to be different than somebody like myself for the secondary market. The secondary market is not the bank. The
Yeah.
banks are financial institutions. Secondary market is money that's coming from Wall Street, and they just have different underwriting criteria. And at the end of the day, I can sit here because I broker out 30-year loans, but I don't know that exact scenario. Like, we have to have a loan app. We then have to run the loan app by the secondary
Yes.
market investor,
Yeah.
and it takes time.
Yeah. Yeah. That's not an easy ask of a bank, but this is why you like a big problem that I have with newer investors that are coming into the space. They're like, oh yeah, my lender's on my team. But they don't actually do this. They don't have these conversations with their lenders beforehand and be like, what is expected? What can I do? What can I, for more or less, get away with? Like, how can I get this done with where I'm at? And I think that's a very important conversation that they need to
It
have with
is.
every
It
person on
is.
their team.
Absolutely. I think probably a lot of people don't have that conversation because they're scared of what the result of that conversation would be.
Yeah.
And you like, as a real estate investor, you have to realize, like, there are thousands of different roles or different people that you can go to build your team. So if one member of your team doesn't fit
Yes.
your model, then find a different one. Like, it's not the end of the world. And I think too many real estate investors, they're like, oh, well, this team member said this. I guess I'm done. I can't do any real estate investing. And there's so many different I'm very open. I'm not the best fit for everyone, but there's a whole list of lenders out there, private lenders, true private lenders, that will work with somebody because they have different criteria. They have different risk tolerances.
Yeah. So now let's kind of cut back over to that guy or lady who has zero, no money. They don't have a retirement account. Maybe they're even renting there, so they don't even own the home that they live in to tap into a HELOC.
Yeah.
They have, let's say they have decent credit. They're in like the 700 to 800 range. And they make enough money to live on. They have a decent job. This isn't a minimum wage worker that they're a maybe someone who works in construction, a tradesman maybe, or a professional. So they have some time or they have some skills. They make enough money to live on right now. Should they start thinking about, like, how do I get my first deal acquired? Do I really need to just sit down and save up $30,000 in the bank so that I can do my first deal? Or is there some hope for me? How do I incorporate some of these strategies that we've talked about? How do I approach that conversation with the lender? What do you got for them? Any advice?
Well, I think one of the strategies that you mentioned and brought up today, and we briefly discussed, was the subject to. Subject to is a great way for someone who doesn't have the money or they don't have the credit. And I would venture to say that credit's probably, a harder thing to maintain than just saving up money. So if you don't have the credit and or you don't have the capital, a subject to is a great way. The blatant thing is you have to get out and hustle. You have to get out and find those deals. You can't go and contact a real estate agent and say, hey, listen, I'm looking for subject to properties on the MLS. Not going to happen. So there's the easy way, which is you've got plenty of money. You've got credit. Go out, find a deal on the MLS, put under contract, close on it. Like, that's an easy way.
Yeah.
But if somebody doesn't have those, and there is a lot of successful real estate investors don't start off with those two key ingredients, money and credit. So how do they get started? They have to go out and hustle, and it's a lot of work. And really, I would encourage anyone that's looking at getting invested in real estate, like, do a good hard self-assessment of how committed are you to being successful? Because if you're not willing to stop watching football games, stop watching baseball games, and go out and hustle, it's probably not going to be a good fit for you. If you're not willing to stop watching just TV in general, if you're not willing to stop going and spending money on things that you don't need to, instead of maybe allocating money towards marketing, real estate investing is probably not a good fit for you. So there's this level of discipline. And if you look at any successful real estate investor, they all have one major ingredient, and that is the ability to discipline themselves to do what's necessary to put off the immediate satisfaction of relaxing or going and doing things that they want to do for the goal of accomplishing their goals. So subject to is a great way to do it, but you're going to have to hustle. Yeah. The other thing, that if somebody has no money, no credit, or they're so-so, it's not the best, but the end of the goal is they need to get into a deal, but they don't have the money. So there are two ways to approach this. Number one, they can bring on an equity partner into their entity and that equity partner provides the capital. The thing is, they're giving away a portion of the profit, typically 50%, maybe more. I would say if the deal doesn't make sense for them to give away 50 or 60% of the profit to their capital provider, especially if it's on the first or second deal, or I would say the first 5 deals, then find a different deal. Find a deal that it financially makes sense, right? For somebody to take the risk of investing in you, because they're not loaning you money in the traditional sense of a loan. They are investing into you. They're investing into your vision, into your company to help you get started. Therefore, they reserve a reward that is equivalent to that risk that they are taking, right?
Yeah.
The third option is that you, of course, find a lender that is able, or excuse me, I'm sorry. No, I mean, you're going to have to find a lender anyway.
Yeah.
The third option is wholesaling. So at the end of the day, if they need capital, wholesaling, going out, and again, this goes back to the marketing. You have to find the deals off market. You cannot find wholesale deals on the MLS. Yes, they do exist, but the likelihood that a newer investor is going to find that deal and get under contract is extremely small. And if that's the only location that they're looking for deals, it's not going to happen. So get out there, hustle, knock on doors, beat the streets, go to real estate club meetings, but really and I'm not a wholesaler, so I don't know what the marketing, but there's a lot of courses. There's a lot of people that are specifically wholesalers, and they make a business out of doing that. And going out there, that is the fastest way. I mean, if you get a good property under contract and wholesale it to a real estate investor, do 1 or 2 of those, you're going to have the down payment. You're going to have the money to do your first real estate fix and flip or even long-term buy and hold. I mean, it doesn't take that much. A wholesale deal, you could easily net 15 to 20 or more on a good wholesale deal.
Yep. Yeah, absolutely. Yeah, that's cool. I know for some of you watching, there's a lot of videos. There's a lot of people out there that are, have these educational courses or videos or podcasts on the no and low money down strategies. And I've always kind of had like a personal vendetta against those, because in reality, when you get started, they don't actually work. They're not, well, it's not that they don't work. They're just not no or low money down strategies. They're often, they're deflect that no and low money onto someone else or to something else. So it's bringing in money from somewhere else that you have it set aside or squirreled away, those IRA accounts, those 401k accounts. There's a bunch of different retirement accounts that you can tap into in various ways to access that money to use in real estate investing, which is pretty cool. But it's not a no or low money down payment or system to get it started investing. So I wanted to have like an open conversation about just like, what is it? How do you really do that? What are some strategies that actually work? How do lenders actually look at that? So thank you very much, Edwin, for coming on and having this conversation with me today. Any final things around like the no and low money down that you'd like to say, or any thoughts that we missed out on?
I would say to encourage the investors that are watching to not give up. Continue to beat the streets, continue to knock on doors, continue to make phone calls, continue to reach out to lenders, private investors. I would say know the difference between a private lender and private money. If they don't have the money, they need to find the private lender for the first position loan, and then they need to find the private money to help them with the financing. The private money, they're going to meet in local real estate clubs, in conferences, like going to network conferencing for the real estate industry, even going to your, a networking event that's not real estate focused to find somebody with capital. But it really boils down to, you have to get out there and you have to spend time and effort and energy. But if you do that, if you're committed to that, you will succeed. Like there's nobody that I have ever seen that has been committed to success and set aside the time and the effort and the energy to make it happen and never succeeded. Some people, it takes a few weeks, and that can be depressing, especially for somebody that's been at it for years and they still can't find. It's like, man, this girl from this local club said that they just got started last week and they've already lined up like 300,000. And I will tell you that there's a lot of fluff in the industry. So just whatever you do, don't get discouraged. Don't throw in the towel. Continue to press on, continue to continue. And and if you are committed to setting aside the time and the energy and the effort, you will be successful. It just may take some time, and it's different for everyone.
Yeah, I'd say kind of like added on that. I wouldn't be shocked if a lot of times people meet those potential capital partners like on day one or week one, but those people that would be the capital partners, they're watching to see if you're going to stick in this on the long haul or if you're going to give up after the first week. So
Yep.
like whatever you do, people are watching, and if you're going to those groups, those meetups, they're watching to see if you stick around, see if you're asking questions, see if you keep showing up. And that's
Mhm.
what they're probably going to be looking for, especially if you are brand new and you don't have any
Yep.
like claim to fame or any credit to put behind your name. Especially in the earlier days of you looking and getting started, they're going to look to see if you can at least show up and keep showing
Yep.
up.
Yep.
So yeah, good point. Well, thanks again, Edwin. Thanks for being on episode 3 of Investor Inquiries, I think. So yeah, and if you need help with the private lending, locating your private lender, go back and listen to episode 1 because we dive into all that in episode 1. So yeah, all right, see you around.
See you around, brother. Thank you.